Are you considering 529 savings plans for education? I will go over everything you need to know about starting, contributing, and withdrawing from 529 plan, as well as the advantages and disadvantages that you should know about. The 529 plan is legally known as Qualified Tuition Program, QTP, is authorized by Section 529 of the Internal Revenue Code, thus the name 529 plan. It is a tax advantage savings account designed to help individuals save for education expenses, particularly for college. There are two main types of 529 plans: college savings plans and prepaid tuition plans. The college savings plans let you invest your contribution into flexible investments. You are not required to live in a specific state, and you can use these funds for any college or university you choose. On the other hand, the prepaid tuition plans typically have residency requirements and cover public in-state colleges sponsored by the state. How do they work? These plans let you pay today's college tuition rates for future attendance at that specific school. However, of the 22 states that used to offer these plans, currently there are only 9 that are open to new enrollments. How do you purchase 529 plans? There are 2 ways. The direct sold plans can be purchased directly from the state. They typically have lower fees because you are not using a broker or a financial advisor. The broker sold plans involve buying 529 plans through a financial advisor or a broker, such as Fidelity or Vanguard. They may have higher and additional fees, so compare your options before you open an account. Before we dig deeper into details, let's briefly go over some of the advantages and disadvantages of the 529 plans. 529 plans have high contribution limits, but they can have limited investment options. There are 3 main advantages of 529 plans: tax-deferred growth, tax-free withdrawals, and tax-deductible contributions. However, there is limitation how many times you can change the investments. It's twice a year, plus whenever you change the beneficiary. All the funds that you take out have to be used for education, otherwise you can be penalized 10% on the amount that you take out. You may have to pay taxes on earnings and possible state tax deduction recoupment. Additionally, not all states allow you to deduct it from your state taxes. Another benefit is there are no income restrictions to contribute to 529 plan, but the amount of funds in the plan can affect your financial aid up to 5.64% of the assets for your expected family calculations on FAFSA. Additional flexibility with 529 plans is that you can use it for most education expenses. However, if you have small amount of expenses, you have to be careful if you want to also claim tax credits, receive a scholarship, and take out 529 withdrawals, because you have to use separate expenses for each of them. Finally, one benefit that's coming in January 24 is the ability to transfer unused funds to Roth IRA for the child. However, there's several restrictions on that, so you have to be careful how you go about doing that. What are the federal tax incentives for opening a 529 plan? None. The federal government doesn't provide a deduction or credits on your taxes for 529 plan contributions. But where the benefit is with the states. The tax benefits of the 529 plan differ by states, and some may offer you tax deduction, tax credit, or nothing. There are 9 states with no income tax and thus no 529 deductions, such as Florida or Texas. 3 states that do charge income tax but do not have 529 state tax deductions are California, Hawaii, and Kentucky. However, the other 37 plus District of Washington do offer either a tax deduction or tax credit. Many range from as little as $1,000 for a single taxpayer to a maximum of $20,000 for joint filers. And there are also few that are extremely generous. They will allow you to deduct the full amount of your contribution from your state taxes. That's Colorado, New Mexico, South Carolina, and West Virginia. Now, if you live in a state that doesn't have income tax or doesn't offer the 529 plan, you can open a 529 plan from another state provided they accept non-residents. You won't get the tax deduction or tax credit, but you will receive other benefits like tax-free withdrawals and earnings if the money is used for qualified education expenses. Before you open 529 plan, make sure you do your due diligence and check on the fees and the investment returns for each of the plans you're considering, either from your state or another state. Two good resources for that are ratings done by Morningstar and Investopedia. When you do research your plans, consider the investment options that are offered. You often have a range of investment options, including various mutual funds and ETFs. Few of the usual options are target date or age-based funds that adjust investments based on the beneficiary's age and shift funds into more conservative investments as the beneficiary gets older. Static fund portfolios usually maintain a consistent mix of investments. Actively managed funds may have higher fees as they involve financial advisor, but could result in higher returns. Let's go through an example. How you find out what's the rate of return on your 529 plan. Let's say we have $20,000 of contributions and we have been saving these for 18 years. And the current value in our portfolio is $45,000. And so the $25,000, that's earnings on the $20,000 of our contributions. To calculate the annual rate of return, you can either use an online calculator or use Google Sheets or Excel and use the rate formula. Once we plug in the numbers, the annual rate of return for this investment would be 4.61% in annual return in our 529 plan. Under the current law, you can change your investment twice a year or when you change your beneficiary. Let's compare an investment in 529 plan versus brokerage investment. Let's assume your account value is $45,000, of which $20,000 were your contributions. Under the 529 plan, you would be able to deduct this on majority of state taxes. However, if it's just a brokerage investment, you don't get the tax deduction. Now, let's say at this point you're going to distribute the whole amount. The $20,000 is the return of your initial investments of the principal, so it's tax-free under both scenarios. However, the $25,000 in earnings that you earn on this investment is treated differently. Under the 529 plan, this is going to be tax-free as long as you use these funds for qualified education expenses. However, under normal brokerage investment, that amount can be taxed as long-term capital at 0, 15, or 20%. Let's learn about some of the specific rules and benefits. What is the contribution deadline for 529 plan? If you want to get a deduction on your 2023 taxes, you must contribute to your 529 account by December 31st of 2023. What tax form would you receive for your contribution? None. Unlike some other investments or accounts, 529 plan do not provide tax forms for contributions. You must maintain your records and use your account statements to keep track of your contributions for tax purposes. Now, which education expenses can you pay with 529 funds? A lot. You can pay for tuition expenses and room and board, books, supplies, computers. You can also use these funds to pay for trade schools and certifications, so not only college. Additionally, since 2017, you can also use 529 funds to pay for K-12 education costs, although not all the states allow it. Finally, since 2019, you can pay for apprenticeship programs and pay up to $10,000 of the beneficiary's student loans. Withdrawals from 529 plan account can be taken at any time for any reason. But if the money is not used for qualified education expenses, federal income taxes may be due on any earnings withdrawal. A 10% federal penalty tax and a possible state tax deduction repayment can also be added, except when due to death or disability. Let's calculate whether you have a taxable portion of your 529 distribution. Let's say you have a contributions of $18,000 and the current value of your account is $27,000. That means $9,000 of it is earning. The college expenses were $7,000. And the funds for these expenses were $1,500 in gifts, $3,000 in scholarship, and the rest, the $5,000, was in 529 funds. So the total funds were $9,500, which is more than the college expenses of $7,000. In order to figure out how much of the 529 distribution was taxable, you have to reduce the qualified expenses by tax-free aid. So $7,000 in expenses has to be reduced by $3,000 that the beneficiary received in scholarship. So that means $4,000 are the qualified education expenses, which is less than the total 529 distribution. We took out $1,000 more of the 529 funds than we needed. So portion of it will be taxable, not the entire amount, because portion of it is also a return of principal. So let's calculate the taxable amount of the $1,000 of 529 funds that were withdrawn above the qualified expenses. In order to do that, you have to look at your tax form 1099-Q. Box 1 reports gross distribution, and in our example, that was $5,000. Box 2 reports how much of the total taken out was earnings. Box 3 reports how much you contributed to the plan, and that amount is never taxable. That is return of principal. The amount in box 2 is what is taxable if the 529 funds were not used for education expenses. In our case, from the $5,000 that we took out, $4,000 was used to cover qualified education expenses, but $1,000 was not. So to calculate the amount of earnings that is tax-free, you take the amount of qualified expenses and divide it by the gross distribution to find out the ratio, which was 80% in our example. Then you multiply it by total earnings to find out that $400 of that is tax-free. Therefore, to find out taxable amount, you take the earnings of $500 and subtract the tax-free amount of $400 to find out that $100 of your distribution is taxable and will need to be reported on your tax return, specifically Schedule 1, Form 1040, Line 8. One more thing though, is that taxable distributions are also subject to 10% penalty. If you open the 529 plan, you are considered account owner. You can designate one of your family members as the beneficiary, provided they have a valid social security number or tax ID. That includes family members who are your children, grandchildren, parents, siblings, even family-in-law and first cousins. Actually, you can designate yourself as a beneficiary. You can switch the beneficiary as many times as you want, but you must fill out paperwork each time. There are no federal income limits to open 529 plan. However, some states do impose them for eligibility. Unlike IRAs, 529 plan lifetime contribution limits are very generous and are determined by individual states, ranging between $235,000 to $550,000 across all accounts for a single beneficiary. Now, what happens if your child receives a scholarship and you have all these funds in the account? You can actually withdraw 529 funds up to the amount of the scholarship. You won't pay penalty for doing that, but you have to pay taxes on the earnings on the funds. Can anyone else, including grandparents, contribute to 529 plan? Yes. In 2023, you can gift up to $17,000 to a single 529 plan, so per beneficiary, without it affecting your lifetime gift tax exemption. Let's expand on that. Can grandparents contribute to 529 plan and get the state tax deduction or credit? Yes, grandparents can claim the deduction for contributing to 529 if they live in one of the 34 states that offer state income tax deduction for contributions. But do they have to own the account? In 2/3 of the states that offer these state tax benefits, anyone who is a resident of that state can take the deduction, even if they don't own the account. Some states, though, require that you are the account owner to get the deduction. Can you open another 529 account for the child if the parents already have one? Yes, there is no limit on the number of 529 accounts that can be opened for one beneficiary. However, communicate with the parents that there is not the maximum lifetime contribution limit reached. There's also a very cool rule which allows you to superfund your 529 plan, which allows you to put in 5 years worth of funds in one single year. So for 2023, that is 5 times 17,000, which equals 85,000. You would have to file 709 gift tax return and prorate it over a 5-year period. Check the box on Schedule A. Also be aware of losing any state tax deductions or credits. Let's go back to the situation when either the beneficiary didn't go to college or didn't use up all the money in 529 plan. What then? Starting in January 1st, 2024, you can roll over up to $35,000 from a 529 plan to a child's Roth IRA without penalties. But there are a few conditions. The 529 plan must have been open for more than 15 years for this rollover option to apply. The rollover funds cannot include contributions and earnings within the previous 5 years. They're subject to the annual Roth IRA contribution limit, and the beneficiary must have compensation in the year of the rollover equal to the amount transferred. What happens if the 529 account owner dies? When you open the plan, make sure you designate a successor so the ownership is transferred to the new person. Most 529 plans don't allow joint ownership with a spouse, so it may make sense listing them as the successor. You can also select someone else. If you don't specify the successor, the estate becomes the owner. When you withdraw money from 529 plan, you will receive a tax form 1099-Q, which reports the withdrawal amount, earnings, and the principal, basically the basis in the plan. You usually don't need to report 529 withdrawals on your tax returns as long as the funds were used for qualified education expenses. You have to make the calculation yourself and save for your records. The American Opportunity Credit can lower taxes up to $2,500 per student per year for 4 years, based on $4,000 of expenses, but you can't use the same expenses to claim it and also cover with the 529 tax-free withdrawals or tax-free scholarships. One set of expenses that never overlap is the room and board expenses, which you can pay with 529 plan, but you can't include for American Opportunity Credit or Lifetime Learning Credit, and that are rarely covered by scholarships. The best approach is often to first use scholarships, then the American Opportunity Credits or Lifetime Learning Credit, before tapping into 529 savings. Because remember, you can use the 529 savings also to pay off student loans, which you may be paying for many years. What are the main disadvantages of 529 plan? The primary disadvantage is the potential impact on financial aid through FAFSA. These plans can influence your financial need assessment with a maximum rate of approximately 5.6% of the 529 assets, affecting the expected family contribution in federal financial aid calculations. Additionally, there are timing issues such as needing to take out money to pay for education when the market is down, as well as investing in more risky investments with the possibility of losing the savings, including the principal. Thanks so much for watching.